They surged when the world expected them to stumble. That exclamation echoed through boardrooms across the United Kingdom in the wake of the FTSE's remarkable climb. With so many headlines screaming about political unrest, weakening consumer confidence, and threats of new trade barriers, few predicted that the FTSE 100 would end up defying the doomsday forecasts. Yet here we are, in the middle of a thrilling financial drama that proves markets have a way of surprising even their most dedicated observers. Today we will peel back the layers of this unexpected story. How, amid economic turbulence, did the FTSE 100 manage to rise by around 7.2% in just the first 6 months of 2025? Why are trading floors buzzing with excitement while experts scratch their heads at the index's resilience? And which companies, once dismissed as outdated or too risky, are suddenly looking like prime targets for savvy investors? In this in-depth exploration, we will delve into two standout names, Standard Chartered and Vodafone. We will uncover what sets them apart, why their valuations remain so appealing, and how their underlying businesses are navigating the complexities of a rapidly changing global landscape. Along the way, we will question whether this newfound performance is driven by genuine growth or if it merely reflects the market's collective thirst for bargains. Above all, we will try to answer the biggest question of all. Does this dizzying ascent in the FTSE have momentum, or is it fated to drift back to earth? But our journey begins with the contrarian's tale, the notion that if a stock or an entire market has lagged behind for too long, at some point investors may rush in to snap up deals. Opposing the widespread negativity can be risky, but it can also bring rich rewards. Over the past few years, the UK's flagship index has occasionally looked worn, overshadowed by more glamorous global benchmarks. Yet, that depression in sentiment has yielded pockets of opportunity. Prognosticators and professional traders alike have marveled at what seemed to be a storehouse of sleepers within the FTSE 100. Then, as if out of nowhere, came this fresh surge in stock prices. Critics point to cyclical patterns. Markets often bend under gloom and then shoot back up as soon as macroeconomic data shows even slight improvement. And indeed, in 2025, the gloom was thick. Concerns range from talk of overbought technology stocks in the United States to anxieties about interest rates in the United Kingdom and the Eurozone. Some believed that surging inflation would crimp consumer spending, sending many venerable British corporations into retreat. Yet the numbers this time contradicted that narrative. By the midpoint of 2025, the FTSE 100's robust climb was making headlines. Investors had apparently picked up on strong fundamentals beneath the surface, and the index's leap of approximately 7.2% raised eyebrows everywhere in the financial world. One reason for this resurgence can be traced to big businesses that remain fundamentally sound even during the rocky moments. Enter Standard Chartered, a bank whose story has been shaped by its expansion in high-growth regions. A few years back, some doubted whether leaning heavily into markets such as Asia and Africa might backfire, especially given regulatory changes and foreign exchange volatility in certain countries. Yet Standard Chartered's consistent quarterly results have shown that strong demand for banking services, coupled with strategic cost management, can produce a surprising degree of stability. In fact, the bank's group pre-tax earnings rose by double digits yet again in the first quarter of 2025. Still, the bigger shock is that Standard Chartered appears to be undervalued by multiple metrics. Though share prices fluctuate daily, the bank has been trading at a price-to-book ratio hovering around 0.8, a number that indicates skepticism among many investors. Typically, a ratio below 1 suggests that the market is pricing a company below its inherent worth. Of course, no one can guarantee that the discount will disappear overnight, but it does raise the question. If the bank is generating stable profits and tackling high-potential markets, why is it selling at such a low multiple? This leads us to another clue about the bank's intriguing position. According to projections, its bottom line could expand by a healthy margin in 2025, and that improvement in profit flows through to a very friendly price-to-earnings-to-growth ratio of around 0.8. For those unfamiliar with the terminology, a PEG ratio under 1 often signals that a stock's earnings growth is not fully priced in. In other words, the market might be missing just how much Standard Chartered can benefit from the demographic and economic tailwinds driving many emerging regions. But do not be fooled into thinking it is all sunshine and roses. If interest rates decline or competition intensifies, a bank's margins can shrink. And with lingering uncertainties about China's growth trajectory, there is still some risk attached to Standard Chartered's strategy. Yet the bank sports a sound capital position, boasting a common equity Tier 1 ratio in the realm of 13 to 14%. This robust capital foundation could be channeled into new lending initiatives or acquisitions in underserved locales, fueling further expansion. It is not just a tale of numbers, it is a story of possibilities. Meanwhile, we have another titan on the radar, Vodafone. Once upon a time, the brand name alone was enough to conjure up images of unstoppable success in telecommunications. However, Vodafone's journey in more recent years has involved strategic reworks, regulatory battles, and pressing questions about how to handle its substantial operational costs. Germany, a vital market, experienced regulatory shifts that complicated the bundling of services, denting revenues and forcing management to rethink the approach. So, why are some analysts now speaking of Vodafone as a hidden gem? The telecom giant's price-to-earnings ratio, projectedly just a bit above 10, mirrors a broader skepticism about Europe's mobile and broadband industry. Yet, historical averages suggest that leading telecom groups, especially those offering robust coverage, tend to trade at closer to 18 or 19 times earnings. Is Vodafone perpetually doomed to linger behind, or does this discount signal a compelling opportunity? Much like Standard Chartered, Vodafone's story has a large international component. Africa, for instance, remains an arena of rapid transformations. With mobile money services, data usage, and smartphone adoption accelerating, the demand for reliable connectivity seems almost insatiable. Vodafone, leveraging local partnerships and well-known brand recognition, hopes to ride this wave of digital expansion. Some commentators, perhaps a bit cynically, caution that profit margins can still be squeezed by local competition and infrastructure expenses. Nevertheless, the potential for growth in these emerging markets is difficult to ignore. If you are impressed by how Vodafone is adapting its global reach, take a quick moment to show your support. Perhaps you have your own experience with undervalued stocks that soared beyond expectations. Let us know by giving this story a like if it resonates with you. Continuing with Vodafone, we can see more reasons for optimism. The era of high-speed connectivity is taking root, and new revenue opportunities abound in areas like the Internet of Things, streaming platforms, and even enterprise software solutions. By rolling out faster broadband networks and harnessing fifth-generation technology, Vodafone may well unlock recurring income streams that were inconceivable just a few years ago. Interestingly, the prospective dividend yield sits at around 5.5%. A figure that can attract income-oriented investors looking for more than just share price gains. But let us not gloss over the challenges. Telecoms must navigate political landscapes and regulatory bodies that can suddenly shift the ground under their feet. Personalized plans, data caps, and a myriad of licensing obligations can complicate even the most carefully laid strategies. Skeptics caution that mergers and joint ventures, like the potential tie-up with Three in the United Kingdom, may face tough scrutiny. The question remains, can Vodafone execute these partnerships in a way that fortifies its business and steers it into the next evolution of connectivity, or will new competition hamper its progress? Some observers argue that the rumored synergy benefits from deals like that with Three could streamline costs or boost the company's network quality, but others worry about antitrust pushback and complex negotiations. This delicate dance of risk and opportunity is precisely what keeps long-term shareholders both hopeful and on edge. After all, the discount to Vodafone's book value, sitting around 0.5, suggests that the company's intangible assets, market position, and prospective growth in high-demand regions might be considerably undervalued. And that is the crux of the broader FTSE 100 narrative right now. Whether it is banks expanding into new markets or telecom giants redefining connectivity, the index has shown surprising resilience when it might have buckled under the combined pressures of inflation worries, geopolitical frictions, and shifting supply chains. There is a determination among businesses to adapt, innovate, and push forward despite the swirling uncertainty. Simultaneously, investors remain hungry for bargains, scouring the market for established names whose share prices seem to lag behind their actual or potential performance. Of course, it is too simplistic to say that the UK market will forever shrug off adversity. Future economic data might surprise to the downside, or new global tensions might arise, dampening this run. But for the moment, sentiment has shifted, and the wealthy tradition of contrarian investing, scooping up discounted shares at the precise moment the collective mood is sour, seems to be unfolding once again. If you are enjoying this deep dive into the forces shaping major industries and revealing overlooked investment ideas, consider subscribing to our content. That way, you will never miss the future chapters of this unfolding story, where we continue to examine essential trends and developments that could reshape the financial horizon. Another aspect worth highlighting is the role that dividends can play in prolonging the FTSE 100's appeal. With interest rates in flux and bond yields sometimes struggling to beat inflation, equity dividends become all the more attractive. For instance, Vodafone's yield sits meaningfully higher than many savings vehicles, and if the telecom giant can maintain or even grow its dividend, many shareholders will be reluctant to part ways with the stock. Standard Chartered, while not necessarily a dividend powerhouse in the same sense, likewise benefits from returning capital to shareholders through buybacks and distributions, a practice that can instill confidence in longer-term value creation. So, are we on the verge of a new golden age for the FTSE, or is this recent surge a short-lived reprieve? Much depends on the global economic climate and corporate earnings. Yet the mere fact that the index rose by roughly 7.2%, despite a barrage of negative news, suggests that the market might be focusing on tangible fundamentals and undervalued opportunities, rather than dwelling on the doom and gloom scenarios that have garnered so many headlines. For Standard Chartered, the narrative is all about harnessing higher growth territories. That is why Asia and Africa, realms teeming with emergent middle classes, dynamic digital economies, and youthful demographics, are at the heart of its strategy. The bank's robust capital ratio provides a cushion to seize expansion prospects, even if the macroeconomic winds change direction. Meanwhile, Vodafone exemplifies how a mature telecom, grappling with significant competition and regulatory friction, might nevertheless unlock new earning sources by leveraging technological leaps. The synergy projects and expansions across African nations promise to give Vodafone a piece of the rapidly evolving communications market. At the end of the day, some watchers wonder if the FTSE 100's best days are behind it, but this year's data defies that skepticism. Opportunities still appear for patient, discerning stock pickers who can identify bargains in the rubble of discounted share prices. Certainly, caution is wise, as no one can guarantee that short-term gains will persist indefinitely. Yet, for those willing to venture beyond the noise, this might be the start of a more sustained turnaround. We have traversed a journey that began with an unexpected market rally and led us through the compelling cases of Standard Chartered and Vodafone. Each entity tells a broader story about a resurgent FTSE and the potential for growth where few thought it possible. And while pitfalls and uncertainties remain, especially in the interconnected global marketplace, there is a palpable momentum that could propel the index higher. Indeed, the lessons gleaned from these two companies are transferable to many other names within the FTSE 100, each bringing its own set of strengths and vulnerabilities. Ultimately, whether you adopt a bullish stance or a more measured perspective, the truth is that the UK market is alive with possibilities. From banks fueling emerging economies to telecoms laying the groundwork for the next wave of digital connectivity, numerous paths could lead to strong returns for those who position themselves wisely. As the year unfolds, we will stay vigilant, separating the hype from the concrete signals that might herald a deeper, more meaningful phase of growth. So, keep your eyes on the FTSE, lest you miss a key turning point that might redefine your investment outlook. This is a story that continues to spark debates and ignite speculation about what the future holds for both venerable institutions and daring newcomers. Even if political turbulence or unexpected policy shifts arise, the potential for surprising rebounds remains as prominent as ever. And perhaps that is the irresistible mystery of the markets. No matter the prevailing sentiment, optimistic, cautious, or downright fearful, there is always something waiting below the surface, ready to either confound or reward. In 2025, the FTSE 100 has rejuvenated that sense of possibility in a big way, opening the door for hopeful investors to imagine the next stages of growth. Standard Chartered and Vodafone stand as prime examples that, behind the roar of sensational headlines, there can still be remarkable value to be found. Stay tuned for the next chapter of this unfolding drama, where we will keep the spotlight on the strategies, pivots, and bold moves shaping the financial landscape. Until then, keep questioning the consensus, scrutinizing company fundamentals, and watching for those silent signals that might just herald the next great leap forward in an ever-shifting marketplace.